A couple of weeks ago, I told you how you could pay tax at 10% when you come to liquidate or sell your company, but that you could also pay 10% on your earnings in the years running up to that point. And this has triggered a certain amount of curiosity. I therefore thought today that we would spend a little bit of time talking about this in a little bit more detail. This is a slide I put up previously. So you borrow the money from the company pays some tax on that borrowing, you liquidate the company, you pay tax of 10% on the proceeds, you repay the loan, the company gets the tax back on the loan. Sounds pretty simple, doesn't it? But you really need to come and talk to us if you want to do this yourselves. Now, there are three elements to this. The first of these is the tax treatment of directors' loans. Then we need to say something about liquidations, and in particular the anti-avoidance rules, which are coming this year, and the qualifying conditions for entrepreneurs' relief. When it comes to directors' loans, the tax charge is 32.5% of the outstanding loan. The trigger for that tax charge is that the loan is outstanding at the year end and has not been repaid within 9 months. The payment date is the same as your normal corporation tax. But the big difference between this and normal corporation tax is that the tax that you pay on the loan, you can get back. When it comes to liquidations, there is some new anti-avoidance to stop people doing serial liquidations. And so if within 2 years of receiving a payout from the liquidator, you carry on a similar trade, then under certain circumstances, you can find yourself paying income tax on the payout and not capital gains tax. Treatment of distributions or payouts from the liquidator. These are generally treated as if you had sold some or all of your shares and so subject to capital gains tax. Watch out for the new anti-avoidance rules, as we've just been speaking about. And also, you probably need to speak to us about whether liquidation is actually the most appropriate route in your particular circumstances. Entrepreneurs' relief, obviously the big benefit here is the 10% rate of tax. When it comes to capital gains tax, there are conditions relating to the percentage holding of ordinary shares and also being a director. Watch out, because some shares are actually ordinary shares but are described as something else, and this might dilute your shareholding below the qualifying level. Bear in mind that you can get many of the same benefits when it comes to selling your company, but the qualifying conditions are subtly different. So it's a good idea to come and speak to us ahead of any planned sale. So in summary, what we're speaking about here is how you can extract funds from your company, how you can sell the shares in your company and only pay tax at 10%. Come and speak to us if you want us to have a look at this a bit more closely. I'm Alan Long from the Long Partnership, making life less taxing.